The National Association of Home Builders just issued their biggest housing reset warning since 2009. Builders are not building. Housing starts are collapsing at the same pace as 2008. The industry itself just admitted it. Here is the update you need and what people did in 2009 that worked.
The industry that constructs American homes just issued its biggest reset warning since 2009. And here is why it is actually worse than 2008 on two dimensions nobody is talking about. In 2008, the Federal Reserve was cutting rates aggressively, which meant as prices dropped, affordability was improving, and a floor was forming under the market. Today, the 30-year fixed is at 6.65% and climbing because the Iran war pushed up oil prices, inflation expectations, and treasury yields. No floor is forming. In 2008, material costs were deflating as demand collapsed. Lumber fell, steel fell. Today, 62% of builders report suppliers increased material costs specifically because of fuel prices from the war. Prices builders can charge are falling while costs are rising. The squeeze is coming from both sides simultaneously, and the builders are trapped in the middle. That combination has not happened before. When the people who build homes tell you the market looks like 2008, they are not giving an opinion. They are reading their own order books. And the last time those books looked this way, the recovery in the worst hit metros took 8 years. By the end of this video, you will know exactly where we are in the collapse, how to read the signal before the evening news names it, and the specific moves that could be the difference between buying a house at $230,000 and paying $420,000 for the same house on the other side of the window. Today, I want to walk you through the 5-step cascade confirmed in the current data, why the South and the West get hit first, and the 3 moves that built generational wealth during the last reset. The signal the industry is reading is the NAHB Housing Market Index, the single most validated predictive instrument for residential construction in the United States. In 1994, a peer-reviewed study by John Goodman from the Federal Reserve tested every major sentiment survey in America against actual housing market outcomes. The NAHB survey was the only one that significantly predicted housing starts. The all-time low was 8 in January 2009 when builders were filing for bankruptcy. The current reading is 37, below 50 for 25 consecutive months. January 37, February 37, March 38, April 34, the lowest since September 2025. May 37, no breakout, no recovery, just grinding sideways in the danger zone. 32% of builders are cutting prices. 61% are offering incentives, including rate buydowns and closing cost assistance. 70% cannot price their homes because they do not know what materials will cost next quarter. Robert Dietz, the chief economist, said on the record that recent increases in long-term interest rates will continue to hold back home buyer demand. Here is why that number matters to someone you know. The people who built wealth in 2009 were not the ones who waited for the evening news to confirm the crash. They were the ones reading this index 12 to 18 months before the bottom printed. Tom is in his early 30s. For some of you, you know someone like Tom. He is a peer. For others, a relative, a son, a nephew. There are a lot of people like Tom right now. He works in project management. He has $112,000 in a high-yield savings account. He wants to buy a house. His real estate agent has told him to wait 6 more months, 4 separate times. That is 2 years of waiting and 2 years of rent that built no equity. Tom does not know what the NAHB Housing Market Index is. He has never heard of Robert Dietz. But the index Dietz reads every month is about to determine whether Tom buys a house at $230,000 or pays $420,000 for the same house at the recovery price on the other side of the window. To understand why Tom's timing matters more than almost any other variable, you need to understand how every housing collapse runs. The sequence is always the same. And once you see it, you can see exactly where we are in it right now. The cascade runs in 5 steps, and each step produces the next one. Builder confidence falls first, and it has already fallen 25 consecutive months below 50, proving it. That confidence collapse produces the second step directly. Builders stop pulling permits. Building permits fell 11.4% in a single month in March 2026 to an annualized pace of 1.363 million, the lowest level since August 2025. Single-family permits dropped to 895,000. Multifamily permits cratered 24.9%. When permits fall that sharply, the third step follows within 30 to 60 days because nearly half of all single-family homes begin construction in the same month the permit is issued.
Hey, real quick to jump in, if you're thinking about refinancing your house, buying your own home, or buying rental properties, I put together 2 groundbreaking courses together, my Mortgage Master Pro and Mortgage Investor Pro. The courses speak for themselves. The students have spoken that it has saved them thousands of dollars the next time they went out and bought a house and got a mortgage or refinanced. I can show you everything about the mortgage industry, how to save thousands of dollars at closing, and how to save tens of thousands of dollars over the life of your loan. Check it out. Links down below for both of them. Now let's get back to the video.
Housing starts drop. In 2006, starts were at 2.2 million annualized. By April 2009, they had collapsed to 478,000, a 78% decline. The current reading is 1.5 million and moving in the same direction. When starts collapse, the fourth step begins. And this is where a market correction becomes structural destruction. Builders who borrowed against projected sales volume find that volume has disappeared. WCI Communities filed for bankruptcy. Towsa filed. Levitt & Sons, the company that built Levittown and invented the American suburb, shut its doors permanently. The mechanism that destroyed them was not bad management. It was math. Land costs plus construction costs plus carrying costs exceeded what buyers would pay in a tightening credit market. 32% of builders currently cutting prices while 62% face rising material costs. Is that exact margin compression happening right now? The fifth step is where the reset creates the entry point. When builders go bankrupt and construction collapses, distressed inventory floods the market. Land lots, partially completed developments, finished spec homes sitting vacant. That inventory resets comparable prices downward, and the buyers with cash capture the discount that does not exist in a normal market. You now know where in the collapse we are and how the sequence runs. That is what most people never understand until the window has already closed. Now, here are the specific moves that separate the buyers who captured 2009 from the ones who missed it. The South is at 35 on the HMI, the West is at 28, the Northeast is at 42, the Midwest is at 43, Dallas, Phoenix, Austin, Charlotte, Jacksonville. These are where builder price cuts are deepest, incentives are most aggressive, and the forced seller wave accumulates first. Sam Zell understood this in 2007. He sold equity office properties for $39 billion in February of that year, the largest leveraged buyout in real estate history at the time. He sold at the top. Then he waited. The distressed window that followed ran from 2010 through 2012. Assets at 40 to 60 cents on the dollar in the exact metros where builders had gone bankrupt. The window lasted 6 to 12 months before institutional capital moved in and repriced everything. Tom has $112,000 in a high-yield savings account. Tom does not need to wait for the window. Tom needs to be ready when it opens. 3 moves Tom makes now before the window opens. The first is locking in his cash position. The forced seller wave creates prices that do not exist in normal markets. 3 moves Tom makes now before the window opens. The first is locking in his cash position. The forced seller wave creates prices that do not exist in normal markets. Every month spent trying to time the bottom is a month that could be spent building the reserve that lets Tom move when the window opens, not after it closes. The second is building credit readiness before lenders tighten. And the numbers here are the numbers that matter. Tom's credit score is 705. In a normal market, a 705 qualifies for a mortgage. In a for-seller market where lenders tighten standards simultaneously, a 705 gets declined while a 745 gets the keys. The rate difference between those two scores on a $400,000 mortgage is roughly 0.5%, which is $130 per month, $1,560 per year, and $46,000 over the life of the loan. The path from 705 to 745 is paying down revolving credit balances below 30% utilization and letting 12 months of clean payment history compound. That path has to start before the window opens. The third move is understanding the real cost of the two outcomes Tom is actually choosing between. If Tom waits too long and misses the distressed window, a house that was available at $230,000 in 2028 reprices to $420,000 within 12 months as institutional capital moves in. Tom pays $190,000 more for the same house because he waited for the confirmation the index already gave him. If Tom buys at the wrong signal before the reset completes, a house priced at $450,000 in a still falling market could drop to $350,000, and Tom goes $100,000 underwater. The zip code matters, the HMI reading matters, the permit data matters. Knowing which metros are in step 4 and which are still in step 2 is the difference between Tom as a buyer who captured the window and Tom as a buyer who became the case study in what the window costs when you miss it. 2 houses in 2028, same neighborhood, same square footage, same school district. One bought by Tom at $230,000 during the distressed window after the forced seller wave arrived in Phoenix. By 2030, that house is worth $420,000. Tom put $112,000 down. His mortgage on the remaining $118,000 is manageable. He has $190,000 in equity built on a reset that most people called a crisis. One bought by the buyer who kept listening to the agent who was wrong 4 times. Same house. Purchased at the recovery price of $420,000, $200,000 more. The equity Tom built from the reset is the same $200,000 the waiting buyer handed to the market before making their first payment. The NAHB has been below 50 for 25 consecutive months. The permits just fell 11.4%. The builders are cutting prices while their costs are rising. Tom has $112,000 and a decision to make before the window opens and closes without him. Is he building toward that decision or still waiting for someone else to make it for him? Economic Ninja is out. Stay ahead of the reset.